The highest margin statistics we've ever seen. There's only been 5 other periods in recorded history where we've got a new all-time high, and that's just recently happened over the last couple of months. So what does it mean for all of us as traders and investors? Well, in today's video, we need to take a look at what it really means for volatility into the back end of September and, of course, October, and why Wall Street might be gearing up for a very volatile time. Join us today as we cover everything in Pepperstone's Macro Edge. See you soon, guys. This one is not to be missed. Well, welcome back, everybody, to Pepperstone's Macro Edge. My name's Thomas Atkinson, and in today's video, we have a lot to discuss, including the big key data and macro levels, and then, of course, some of the statistics that could be happening over the next coming weeks and months. Also, we'll finish it up with the charts and the lead indicators of what you need to be watching right now to see whether the markets are still going to be bullish for a while or whether there could be trouble on the horizon. We'll kick things off here by taking a look at the latest margin debt levels, though, because they are astronomical. And as you guys know, each other previous bubbling period has always risen in margin debt before eventually something has gone wrong. Now, does that mean it's happening straight away? Well, the short answer is, of course, no. Generally speaking, when you make new highs, such as we did just a little while ago, you tend to see a continuation for quite some period. And that suggests that when dips do happen in markets such as the S&P 500, for now there may be buyers behind each dip. And the reason is because of the leverage, because of, I guess, the euphoria that's coming into these markets. Now, there are a couple of worrying signs, and a lot of that does have to do with this kind of euphoria and margin right now. Now, if you're familiar with options, there are both calls and there are puts. Well, just recently, we passed through a threshold that we've seen a couple of times over the last 12 months, which is a 0.45 ratio. And you can see here, this PCC, courtesy of Seth Golden over on X, has a very important level really marking it out. And what it suggests is that we might be just away from a small pullback in markets such as the S&P 500. When everybody goes euphoric, calls tend to rise, and the amount of puts in the system tends to drop through the floor. And that's exactly what's happened as of the 0.45 ratio. It really lines in with some of the stats that we've been recently using, such as Subu Trade's one here, which suggests that the market has been euphoric and also in a bit of a bull run for quite some time when it comes to overbought metrics. One of those is the RSI. You may not be aware of this, but the RSI has remained above 45 for 102 consecutive plus days. And that puts us into some pretty rare times. You'll notice here we only have 1, 2, 3, 4, 5, 6, 7, 8, 9 other periods. And in all of those periods, 2 weeks later, the market was relatively volatile because, of course, it did drop an average of 2.17%. Now, this is all important. And of course, looking at these stats is key. But is it also lining up with sentiment across the board? Well, according to the latest Goldman Sachs report here from Sherwood, you can see it is kind of lining up because euphoria in retail traded stocks, these are the ones such as funds like ARK-K, Nvidia, and of course, things like PLTR, Hood, these types of stocks this year. That basket of trades has been doing very, very well. And it's seen some of the biggest inflows in recent times. And this is leading into, of course, the best performers over the last kind of week being something that we've tracked for quite some time. Semiconductor breakouts, such as we looked at 2 weeks ago. And of course, gold as well, which is now becoming fast, maybe the most popular metal out there well, I guess it always is, but it's the most popular trade out there when it comes to being bullish. Gold actually pipping semiconductors as the best performer in terms of sectors over the last 5 trading sessions. Why is this all important? Well, sometimes markets run away before they go bad, at least for a temporary pullback. And we've just seen another big read here, which is the biggest monthly jump in high beta Momo ever in history. Now, this is a huge read here. And when you actually take a look at high volatility stocks, you can really see the latest JP Morgan report here really running through similar to what we saw during that 2020-2021 period, where it was all about high risk, high reward, high volatility style stocks. Have a look at the performance since this year's Liberation Day, and you'll clearly see that at the moment, the track is, of course, towards the upside. But that can bring volatility, and when we reach similar periods back in 2021, you can see things started to get highly volatile out there. So at least on the macro or data side, maybe it's time for having a little bit of risk management. At least that's what the data suggests. Retail imbalances also show that us, the retail traders, are going along at faster records than a while ago. And of course, this has been a pretty consistent time for retail to be bullish. And it does seem like a lot of it's coming in levered form. So not only is margin debt going up, but also people margining, even margined single stock ETFs has also been going up. And this provides one of those points in time where sometimes retail and Wall Street can kind of get a little bit caught up. Wall Street, of course, wants to make as much money as possible, and retail does as well. So sometimes when big leverage comes in, e.g. that put-call ratio, it can suggest that the euphoria is coming through and there could be some profit to be made by creating that stance in volatility. Well, it does make sense that this is the most volatile period of the time. So this is the back end of September into the beginning of October. And you'll notice here similar stats to what we've shared before on the macro edge here for Pepperstone. It does suggest that we're coming into that volatile period. Now, you never want to go and trade off these periods themselves, but you certainly want to be aware. And the reason you want to be aware is because you're looking at the trend and you're saying, okay, well, where is the support? Where is the resistance? Where are these key levels we should be looking at in markets? Here's the latest data from Whaley, and he again suggests that, yeah, it's a pretty volatile period this week. A post-options expiration week, happened last Friday, does tend to be more volatile than most. Only 8 of the similar kind of 30 studies were up and 22 were down, again suggesting it does tend to be a little bit volatile. And also, we're seeing those flows again into what you would consider like the world's biggest hedge, which is, of course, gold and gold miners. Recently, gold miners going very, very high, and investors actually buying the most they have in 3 years, which has really led to some of these massive rallies up. So why is all of this happening? Well, some people are saying it's the loss of faith in the US dollar. You can see here the dollar has been on its worst record ever. For Financial Times here has a really cool overlay of all the kind of starts of the years over time. And you can see here 2025 is not looking too good when you look at that. But the good news is that even if we do get volatility, some things made new all-time highs last week. One of those was, of course, notably the Russell 2000, the small cap stocks. When they go up, it does tend to beget further strength. And you can see here, according to Ryan Detrick's data, 90% of the time when a market has gone up to a new all-time high, such as the Russell, then it does tend to, of course, lead into further strength. So even if there's volatility, there may be buying just around the corner. And this is where, of course, it all comes back to that most important bit of data from last week. The Federal Reserve signaled to us a little while ago, which we reported here on the macro edge, that we're going to have a cutting cycle. Now, why is that important? Well, of course, the Fed went from a dual mandate, that is dealing with inflation and dealing with interest rates and unemployment, to just saying we need to deal with unemployment. Now, when a big cut happens, and it's been a while, so this is a new starting cut because, of course, the last time we had it was like 12 months ago, the market structure will be all important. It usually does rally up first. The question is, do we end up going to further rallies, or do we see a sell-off that then can't make back to those highs? Remember, a recessionary path since the 1990s tends to look more like that, and a good next 12 months, next 6 months in the markets tends to be strong. The key here will really be, though, what leads it. Will it be large caps or small caps? Let's now take a look at the charts and see how everything's lining up. And there are some good bits of news in the markets. I think if you're looking at the weekly, monthly, and daily, of course, from the technical side, everything kind of looks bullish. If you're looking from the advanced decline line, that has been going up as well, which has been good. But if you go a little bit further out and you go to the weekly, you can see there has been a little bit of a decline in the types of broadening of this particular run. Now, what we do have on the S&P 500 is a fairly overbought market. So last week we thought about it, and if we'd taken out this high, which we did, which was that 66 kind of 30 zone, then it was likely we would push towards the next level, and that being 6,700. Now, that's exactly where we've found ourselves right now. And the importance of this level is that there are a lot of calls there as well. And this suggests that we have what we call a call wall buildup. And remember before we had that put call ratio, what we found was we have a lot of calls in the market and not that many puts expiring over the next couple of weeks. And what that suggests is there's an imbalance. Basically, euphoria could be taking a little bit over, and this could be a very important level. So for all traders and investors, really around the 6,700 will be an important point. But when we get reads such as this, which is an extreme overbought level, we need to be really starting to look at the opportunity on the horizon, because of course levels such as the 20 moving average here on the daily, which is one of our favorite moving averages, is going to be key in the future. If we do get a pullback, where might we find buyers? Well, the last time that we came down to this level, we found pretty swift kind of purchasing around that zone. So of course these levels will be wanting to be paid attention to, especially over the next coming weeks. In terms of lead indicators, yields have been going up since the rate cut happened. Remember, the short yields, guys, they're controlled by the Federal Reserve. But the long yields, the 10, the 20, the 30, they're controlled by the market. The market's suggesting there may be some concerns about reinflation. But at the same time, risk is clearly on. Consumer discretionary versus staples continues to go higher. So, of course, the markets are suggesting, at least for now, it's bullish, bullish, bullish. And the arcade kind of funds and these hyper growth, high volatility stocks, they're also rising up here and breaking through, which is an important read. Also, Russell 2000 is holding its own versus the NASDAQ as well, which of course is a pretty important thing to be looking at. When it comes to the US dollar, it's also gone up since the interest rate decision last week around this point, and you'll notice it's hit into its first resistance. Now, if you're a currency trader on the Pepperstone platform, this is a very important level to watch because it's that first suggestion of whether we are continuously in a downtrend here for the US dollar. And if we do rise up again, what is going to be an important level is around this 98.10. And you can actually use things such as the fixed range volume profile to see here that there's a lot of trade that's gone through 98 to 98.10 in the past. So if this does break through, you'd have to think that the market may make its way up here, and then the real decision of whether it's bearish or bullish will happen. The good news is for currency traders is it does look like volatility is on the horizon because some key levels are happening. When it comes to gold, gold is just doing very, very well. And we have talked about this quite a lot. The pennant formation, the length of the pennant, if it is to go up, 4,000, 4,200 on the macro side could be really big. And silver continues to find strength to strength to strength. So again, from the macro side, we're seeing a lot of hedging there. Oil is certainly less clear. You can see here that oil is really quite range bound at the moment, looking for direction, maybe above 64.80 for the bull end, and for bears to really take control below 68.60 close. Maybe that will continue the sell off on that. But really, it's about semiconductors. Semiconductors and gold, they've both been rallying all year. They continue to look like they're rallying. And NVIDIA could be at its most important point. So if you have a look at NVIDIA here, it's back to that resistance. And this just so happens to also be a call wall. So it's one of those important levels where if we break through here, it suggests that maybe Wall Street is ready to continue on with the flow. If we find resistance here in selling, then that may line up quite well with the fact that there's a bit of euphoria from the retail kind of trader. Main markets around the world are still very bullish, Russell 2000, NASDAQ, etc. And all eyes will be on Bitcoin as it has reached in to the first level of demand since rallying through that key level we spoke about a few weeks ago of about 112,000. So will the Bitcoin bulls come back? Of course, it's currently following very similar cycles to last time. As always, guys, one of the key things here in markets is to always understand that there are volatile periods coming up. We have the Fed Chairman Fed Chairman Powell coming out this week, of course, on Tuesday. And then we also have core PCE on Friday, which is one of the favorite kind of data points for the Fed. And actually a lot of FOMC speakers. There'll also be the GDP this week, which will come in. And of course, that will break down the news. But I think the key to always note is that the charts are still quite bullish. There are a couple of problems here to do with euphoria and, of course, retail imbalance, which is just basically people getting a little bit ahead of themselves. But for now, it does look like at least the market, even if it does get pullbacks, may still have buyers around there. What do you guys think, though? Let us know in the comments down below. And, of course, give the video a like and make sure to subscribe to the Pepperstone channel if you enjoy what you're getting here. See you next time on the Pepperstone Macro Edge.